So good afternoon, everybody. For those of you who don't know, my name's Anthony Murphy, the founder and CEO of Lucerne Investment Partners. And today I'm joined by Marcus Bogdan, the Chief Investment Officer and founder of Blackmore Capital, who we've worked with since Marcus started both his ASX 200 strategies, the blended Australian equities and Australian income portfolios back in 2014. Proud to say we're the foundation investor in both of Marcus's portfolios. We thought just a couple of housekeeping matters to begin with. If you do have any questions throughout today's presentation, please do lodge them in the chat screen or the chat function below the bottom of your screen, and we'll be sure to address them throughout today's presentation. Before we jump into a presentation that Marcus has prepared, we thought it was timely to host the update for Marcus today, particularly on the back of reporting season. I was just speaking with Marcus prior to us coming into the webinar, and Marcus was mentioning that well over 90% of the companies that he holds within both strategies have reported. So we thought it was quite timely to provide today's update, particularly with the ongoing uncertainty that we're faced with markets today. Before we jump into the presentation, I thought a good backdrop would be to rewind nearly 12 months to the day when many of us probably felt like the world was starting to end. We had a market correction of 40% in 3 weeks in early to mid-March. There were days where the market was up at 4% at 11 a.m. and closed down 8% at 4 p.m. They really were some tumultuous times in the market. And so one question I think to start with, Marcus, how did you find that time, given you've been a very experienced market participant over the last 3 decades, but how was that experience for you 12 months ago, I guess, against other market backdrops, and how did you survive?
Sure. Thanks, Anthony, and thank you very much for hosting us today. And you're right, we've really gone through three periods in my career where markets have been incredibly unsettled. This is the first pandemic that we've gone through, but it does, for each of the crises that we've seen, whether it was the banking crash in Australia in 1991, or the tech crash that we saw in 2000, the global financial crisis in 2008, 2009, or the pandemic that we were experiencing today, it does highlight to us certain themes that actually do work through that period to give you a better performance through crises. And one is the quality of the companies that you're owning and the resilience of those earnings. And the second part of that is balance sheet strength, that they can work their way through any crisis that it has come through. And ultimately what we really would like to do is to have companies that have actually strengthened their franchise and their position from the crisis. And I think there's a number of names in the Australian portfolio that I think will ultimately be long-term beneficiaries of the crisis that we've just gone through.
Great, thank you. And did you want to perhaps open your presentation, Marcus? Now we can use it as a bit of a guide through today's session.
Yeah, sure. Okay. Can you just... Yeah. Okay. So the agenda for today is we will have a quick run through of what's happened in 2020 and through 2021. It has been a remarkable year for global equities. We're going to look at the valuation metrics of the Australian market in terms of both the PE and the dividend yields. And then we're going to report on the reporting season where we've seen some of the biggest upgrades in the last 20 years. We'll talk about the portfolio, how it's positioned, how we've really, it's a barbell approach that we've got in terms of resilient companies and companies that are recovering and tilted towards a recovery. And then finally, we can just touch on some of the key stocks in the portfolio, and they were certainly highlighted in the last reporting season. So where are we today? it's been absolutely a remarkable recovery. We're sort of 4 or 5% off from the previous peak. So the markets peaked on February 20th. They reached their bottom on the 23rd of March 2020, and since then, we've really staged a sort of a V-shaped recovery. But it's been in three phases. The first phase was the response that we had from the pandemic, and where the policy envelope really expanded, and we saw both not only support from central banks of keeping interest rates at record lows, involving quantitative easing, but we've also seen an unprecedented fiscal response, and that's been a global response, and that's really inoculated economies incredibly effectively. And so instead of having a collapse of these economies have been supported by incredible government intervention. And what that has led to is that the broad economic data has been better than expected, whether it be GDP, whether it be labour, whether it be wages, industrial output. All of those things have been better than expected, and that has translated into better earnings expectations and moving into an upgrade cycle in terms of the earnings cycle. And the final element to it has been the success that we've had in building a range of different vaccines, and that has been incredibly important for not only supporting the rally, but also seeing quite a dramatic shift, a rotation in companies that have been supported in this particular market phase. So this is just somewhat comical, but this was actually released by the European Central Bank as a tweet on Valentine's Day to really highlight the fact that they will, and governments and central banks will be in force pinning interest rates to the floor, providing incredible fiscal stimulus until we're through this crisis. And this has been really the backdrop of supporting all risk assets, and particularly equity markets. So today, and we're starting from quite high valuations. This is looking at the 12-month forward PE for the Australian equity market. We're currently around 20 times, which is, from an historical perspective, well above the long-term average of 14.5 times, and very much similar to the levels that we were around 2000. So prima facie, that means that we have to be somewhat cautious. I think that we've had, the big hockey stick recovery in equity prices, and now it is really more about looking at individual companies and individual sectors where we actually do see there is some value. But that is also illustrative of the fact that we're at the trough of the earnings cycle, and I think that earnings now have to catch up to where valuations are today. The second component of where investors get their return is hopefully capital growth, but also dividend growth. And this slide is actually more encouraging. The current dividend yield for the Australian market is around 3.4%. That is an absolute trough where we've had dividends compressed. And is well below the long-term average of 4.3%, and we think that will start to recover and will recover sharply. Particularly that what we're seeing in in commodity stocks such as BHP, and a recovery in the banks. And so where we are today is that we are at the foothills of an earnings recovery, and what we are seeing is that earnings estimates are being upgraded at a rate that is unprecedented for this market. And so for this calendar year, calendar 2021, we expect earnings per share growth of at least 20% for the Australian market. Now, to put that into perspective, for the last reporting period, we did see the net effect of earnings collapsed by about 20%, dividends collapsed by around 25%. So we're seeing a recovery. It is absolutely V-shaped, and we think that it has got sustainable legs, both in terms of this year and upgrades, which will follow into 2022. So the recovery that we're seeing is significant, and it's really illustrated on this graph of really the performance that we're seeing, the uplift, and the illustration that we really are at the start of this new profit cycle. And we've come from quite an extended period of profit downgrades. Profits sort of peaked in September 2019, and they're now importantly on the road to recovery. So what we've seen so far is that the biggest upgrades have been in financials, in the banking sector. Those results and that recovery has lent us to move back into the banking sector, remembering that as investors, we weren't holding the major banks from 2015 to 2018. We first went back into Commonwealth Bank, and then during the pandemic, we made a sizable investment into Westpac. And what we're now seeing is we're starting to see an uptick in both volume growth. We're seeing incredibly strong capital positions from the banking sector, and importantly, we're seeing a remarkable recovery in dividend yields. And we think that the banks now are priced on sort of 4.5% to 5% fully franked dividends on much more sustainable payout ratios of 60 to 70%, and in a much better capital position as well. We are starting to see some upgrades in the industrial sector, but we're also seeing significant upgrades in the commodity sector, and that's primarily driven from our largest position in that area, that's BHP, and that's been driven by much stronger iron ore prices and much stronger copper prices. A subdued CapEx environment is leading that to be paid back into distributions to shareholders.
Marcus, just on the banks there, you mentioned, for a number of years you've been light on, particularly compared to the broader index. What really drove that underweight position over those last few years before now increasing that position, as you said, by CBA and Westpac?
Yeah, no, it's a really important point that you're making. What we felt in that period from 2015 to 2018 was that the banking sector was over earning, and we do a lot of work both domestically but globally, and we could see that the returns that the Australian banks were getting in terms of return on equity, their profit margins, and also their dividend payout ratios were just too high. And what we've seen is that we've seen a rebasing of the dividends. The other element that we were concerned about was obviously the regulatory environment, the Royal, what was coming in terms of the Royal Commission. And it was once the Royal Commission had delivered their findings that we were able to first go into Commonwealth Bank, which is the highest quality bank in the Australian market and the one that has really led that recovery there. And then through the pandemic, we added to Westpac. And so, banks have gone from being over earning with ROEs of 14% or more back to mid-single digit ROEs. And at that point, we felt that they were under-earning, and then we could see a recovery in earnings going forward there. This slide just highlights the recovery that we're starting to see in this reporting season on the dividend outlook. So where we are now is that, you know, for a number of years, almost over a decade since the global financial crisis, through quantitative easing, through record low interest rates, that has turbocharged growth assets, and what we've seen in that period is that growth assets have had a remarkable performance at the expense of value stocks, and we do firmly believe we're at an inflection point at this point of the cycle where we are seeing much better valuations for that part of the sector, and a much bigger earnings uplift in both cyclical and value stocks. And one of the things that we're looking at here is just the dispersion of what the high PE stocks are compared to the low PE stocks. The spread there is around 21 PE points, which we think is unprecedented. And over time, we do expect to see a better performance from value and cyclical, and hence that's why we're sort of tilted the portfolios more towards that end of the market and away from growth assets at this point in time. This gives you a sense of where the portfolio is positioned, and it is a barbell approach. The earnings resilient companies are the greatest weight in the portfolio, and they have clearly demonstrated both earnings resilience, earnings growth, and the ability to grow dividends throughout this period of time. We've touched on BHP, both Brambles and Amcor, which we recently put in the income portfolio, have delivered very, very sound results, facing into very, very difficult markets, but ability to grow their earnings and to grow their dividends. We're still well positioned in companies like Wesfarmers and Woolworths, and then I was alluding to, we are exposed to earnings recovery companies, and there's a broad mix of companies there. Ampol, News Corporation has been one of the strongest performers that we've had in the portfolio. We're seeing a recovery in their core assets. The largest asset in News Corp is their investment in REA, the digital property group in Australia, and also Move in the US. Both of those divisions are showing strong recovery, and also Dow Jones is also delivering results that are much better than expected. And we still think that there's a big discount in that company there. Cube reported today. That's the logistics and stevedoring company, incredibly economically sensitive to economic activity, and there's clear indications that trading volumes have started to improve. Ramsay Healthcare has been a real underperformer. It's the largest private hospital operator in Australia, and it's also got significant operations both in the UK and Europe. And they are now seeing, particularly in Australia, a recovery in elective surgery. Elective surgery is growing at sort of 2 times the long-term growth rate, and then the other parts of the business, the non-surgical, medical and mental health areas are starting to also show signs of recovery, and then they will be incredibly well positioned once the vaccine continues to roll out in both the UK and Europe to benefit from a huge backlog in elective surgeries. And what we're seeing is that that the public hospital system is contracting with the private system to help ease that backlog going forward. And so we think there'll be elevated earnings recovery for a considerable period of time. And the other area that we've added to is in the energy space. That is through Santos and the recovery that we're seeing in that business. And then finally, we've got positioning in Westpac as well. The most intriguing result in the reporting season was CSL, which delivered a result which was about 20% above forecasts, but they were very, very cautious on their forward outlook, maintaining guidance of sort of 3 to 8% net profit growth. We do think that they will ultimately upgrade that guidance, but I thought it'd be interesting to just talk through some of the drivers in CSL, given that it's been a doyen of Australian investors' portfolios for a number of years. And the business is really in two parts. The largest component is plasma therapies, and that has got long-term growth prospects of around 8 to 10%. The demand is the pipeline is very strong, but what's happened in COVID is that the supply of plasma through collection centres, the largest market being the United States, has been constrained, and that has put pressure on that business. But there's a number of offsets that they're using to support that market. One is that they've got excess inventory. Two, the regulator has allowed a holding period to be reduced. And three, they're also seeing quite significant price rises in that market. We expect that market will remain challenged for the next few months, but as the vaccine is further rolled out, particularly in those Northern Hemisphere countries, in particular the US, we will start to see people coming back to collection centres, donating plasma and helping with supply there. The second part of their business, which has been a huge beneficiary of the pandemic, has been their vaccine business. There has been unprecedented demand for flu vaccinations, not only in Australia, but also in the Northern Hemisphere in the winter that they've just come through. But also our channel checks of CSL is that the demand, the future demand for the next flu season in the Northern Hemisphere has been unprecedented again. And so we'll start to see both a further uplift in volumes for their flu business, and also the mix of of their product range will also see a range of price increases there. So we remain very constructive of CSL in the portfolio. We've recently added to our position there as the prices have been weaker, and we think that it remains a core portfolio stock. So that comes to where we think the outlook is. We firmly believe that valuations are pretty full at 20 times forward PE. So it is very much around looking at individual stocks and individual sectors that we felt that have underperformed this recent rally. These high quality companies that we've got in the portfolio. And we've seen underperformance in companies like Amcor and Brambles, CSL, Cleanaway and Woolworths. And we feel that those companies will continue to deliver very solid earnings and very solid dividend income streams. And so they're the types of companies that we are focused on, that we're overweight in the portfolio, which will ultimately deliver strong earnings and strong balance sheets going forward. So, Anthony, I might pause there and open up to any questions that people will have.
Yeah, thanks, Marcus. Yeah, one question just regarding Cleanaway. Obviously, it's a business that you bought well. Initially, there was the surprise departure of the CEO recently, which often departures don't come when things are going quite well for a business. What were your thoughts around there?
Yeah, certainly Vic, who joined the company in 2015, has led a remarkable recovery in that company. It's been one of the longest held companies that we've held in the portfolio. It's probably delivered the largest attribution to our investors as well through that time period. What happened at Cleanaway in particularly, his resignation is absolutely disappointing. But however, he has built a very, very strong company in an essential industry. The result that he has just delivered has illustrated the benefit of the structure of the company, that this is a vertically integrated, the largest waste management company in Australia, and there are certain infrastructure assets in the group which have got sort of sovereign quality assets in the group. The share price has come back, and I think depending on the type of CEO they appoint, they've got a very effective executive chairman in place at the moment. That we expect that company will continue to deliver very good results, and will actually come out of the pandemic in a stronger position.
Thank you. Is there a chance that you might be looking to further increase your exposure to financials in the portfolio?
Yeah, look, we're watching very carefully. So we've got a very significant position in Macquarie. They've upgraded their earnings guidance in the last week or so. So as a sort of a diversified financial, we've got Macquarie. And then underpinning our banking sector is both in CBA and Westpac. And given the trajectory that we expect on their dividends, that would be an area that we would further consider if there was a pullback in market conditions.
And cash position at the moment, how are you feeling about that, and what sort of catalysts in the market where you might unfold which would allow you to become, or which would trigger you to become more defensive?
Yeah. So 2 points. I mean, we're pretty fully invested at the moment. Cash is around 3 or 4%. That will be increased with the dividends coming in the next six weeks or so. And then it's the composition of where we've got the holdings. And again, I would point to the fact that we've got this very, very strong robust pillar in the portfolio around these leading companies, which many of them have underperformed over the last quarter or so. So we do see a margin of safety in those businesses and their ability to continue to grow earnings and dividends. And then we've got these recovery plays, and depending on how well they will do, we may take some profits in those and then redirect them into other areas.
Yeah, and you were saying before we jumped on the webinar, Marcus, you're feeling that there is this rotation at the moment from growth back into value, but one must be relatively specific in terms of sectors and then stocks that you're targeting given those valuations. Just want to expand on that a little bit more, because it's a big argument at the moment. You read it every day in the AM. Are we still in this growth bull market? Are we seeing a rotation to value that we saw in November last year when the value managers did really well? What's your sort of view and outlook on that argument?
Yeah, no, I mean, we've definitely reduced weightings in growth. One investment which was particularly successful in the blended portfolio was Xero. We bought that at around $36. We recently sold our position there for about $124 They continue to rally, and then they've sort of come back now. But we've used those sorts of funds to build up on those recovery plays. And it's important that, those recovery plays are very solid names with very, very solid balance sheets, and I think are well positioned to continue the recovery. The biggest component of the portfolio is around what we would say quality to reasonable price, which are those earnings resilience companies. And so we want to benefit from the recovery, but we also want to have a very strong, stable group of companies, so that if there is any hiccup in the recovery, or if there's any sort of pullback in the market, they're the types of stocks that have really demonstrated that they're more resilient. They offer less volatility to the overall market, and that's periods of where we've tended to outperform the most.
Absolutely. And Helios is another great call that you've had in the portfolio. I just want to talk a little bit about that business for the audience that might not be familiar with the company, and what's your outlook on the company?
Yeah, sure. So Helios is the second largest provider of pathology services in Australia. It has been a COVID beneficiary of the COVID tests, and they continue to see very elevated numbers there. We've had to be patient with this company. It has been a turnaround. They've de-geared the balance sheet by selling the medical GP products, where they got over $400 million there, and so the balance sheet is in absolute pristine condition. 90% of the business is in pathology. They're the third largest imaging diagnostic company in Australia, and they've recently and successfully moved into day hospitals as well, where they're seeing very, very good growth there. So in the healthcare space, where multiples are generally high, this is a value play in the healthcare sector, and we think that they can grow their earnings between 5 to 10% over the forecast period. The valuation remains undemanding. They are showing clear signs of recovery in their underlying businesses, and we do expect margin improvement in that business as well. So it is a big overweight in the portfolio, and for the moment we're very comfortable to have that big overweight there. So really, to go back to the big sort of overweight positions that we have in the portfolio, it would be Ramsay, it would be News Corp, and it would be Helios as well.
Thank you. Another question here, the dividend yield on BHP, I've just had a look on Iris myself, and it's circa around 3.5%. Is that your read on the current yield based on their recent numbers?
Well, I think the expectation is that can further surprise on the upside, and the longer that we see both iron ore and copper, and now energy petroleum prices at higher levels, the greater upside that we'll see on both from an earnings and a dividend perspective as well. It was very clear from the BHP call that they are still incredibly focused on capital management and returning proceeds to investors. Which
is ironic when you'd ask that question of BHP 20 years ago from an income perspective, right? Who would have thought BHP is one that can appear both as a yield stock these days and a growth. Even 5 years ago, that wasn't the case. So it has been in and out of the income portfolio as a result of that historically. So it is an income play now, which is quite amazing in itself.
Yes, and I think for the forecast period, depending on overall price, it will remain an attractive dividend payer for our investors.
Absolutely. What do you think are the key risks in the market? This is actually a question I was going to ask you as well. What are the key risks in the market looking into 2021? And probably just to expand on that, what catalysts could unfold that you feel that could actually decouple markets, and we could see another correction, because there is a real risk of that occurring, right? And so what do you think personally could be the catalyst that allow for that?
And you're absolutely right. I mean, prices overall are elevated. And so the risks that we see is that this unprecedented stimulus that we've had, both fiscally and monetary policy, is leading to an expansion of bond yields, and that's certainly will ultimately put pressure on certain parts of the stock market, namely growth stocks and bond-like equities, where the discount rate is particularly sensitive to that. But it will also potentially feed into the real economy, and potentially what we're seeing in the US is making US mortgages more expensive, and that's been a real driver of economic activity in the US. And so the first risk is that policy response is so successful that we get an overheating of the economy, and that's reflected in bond yields. The second derivative of that is that we see undisciplined capital allocation, and we're seeing that in parts of the market. Whether it's the SPAC vehicles that we're seeing in the United States, or a range of other asset classes which are very, very elevated. The second risk still rests around the pandemic, the distribution, the rollout of the vaccine. That's obviously taken longer than expected, and if there are any significant variants on the virus as well, that the current vaccines are less successful in tackling. So for us, it's the potential of overheating of the economy, or that we have some hiccup in COVID again, and we have to go back into lockdown as well, would be the two core risks that we are absolutely mindful of, and that's why we do have still a range of resilient and defensive companies in the portfolio.
Yeah, thanks, Marcus. I appreciate that. One more question, I think, here. This is one that'll touch the heartstrings, Marcus, because I know how much you like to travel to Singapore. You usually travel overseas regularly for your research process. So how have you been able to substitute that with Zoom meetings, etc.?
Yeah, well, actually, at the beginning of the pandemic, that was the thing I was worried about the most, about how do we be able to see the companies, to pick up these early trends by doing these company and industry visits, and they're all, it's the backbone of what we do, because hopefully through that company visitation that we can see things earlier, which may be opportunities or potential threats. But like everyone, I think we've been remarkably surprised how successful these virtual meetings have been, and I think they will continue. But we are, at the same time, we will supplement that by going back into the field and doing primary research, first and foremost in Australia, and then our first trip is probably planned for March next year for the northern hemisphere. But in the interim, this has worked incredibly successfully. It has meant that we've had to be a bit more creative in the way that we do things, but so far it's worked.
Great, fantastic. Yeah, it is quite amazing. I can speak for personally how individuals have been forced to change, but everybody's adopted to it very, very well. And you're seeing this innovation economy emerge as a result. We'll probably just take this as the last final question. It's just come through because it has been very topical, and it's an area that a number of our investors through another one of our funds will benefit from, and that's gold. You've obviously got Northern Star in the portfolio. Gold's fallen out of favour a little bit with equity markets doing so well of late. And people historically have seen it as, I guess, a bit of a natural hedge. What's your view with gold, and I guess in particular Northern Star at the moment? Do you see gold prices strengthening again as we potentially move into an inflationary environment as a result of all the stimulus?
Yeah. Our exposure is through Northern Star, which we believe is a very strong owner, manager, operator with assets in safe jurisdictions. It's in a net cash position. It's been able to grow its earnings and its dividends, and we believe that the merger between the two groups and the synergies that they will be able to get from Super Pit will be significant. And we don't mind having some stocks in the portfolio that underperform in booming times, because we do think they're important counterweights in the portfolio. And one of the concerns that we have is the debasing of money and just the huge liquidity that we're seeing there. So we do think that gold does play a part in the portfolio, and then we're sort of illustrated that through, I think, one of the strongest operators in the market, in both in terms of their conservatism, but also their prospects for growth.
Great. Thank you for that. We might conclude things there. There's no other questions that have come through, but Marcus, as always, a really comprehensive update. We love your work. We love the way that you manage portfolios, particularly through down cycles in the market. You did an outstanding job last year. Your approach is very measured and has always given us peace of mind. If there are any other follow-up questions, we'll be sure to send them your way. Thanks again, and we'll certainly get you back most likely in late August, early September, to talk about what might be a very different earnings season, or maybe even a better earnings season.
Okay. Again, thank you very much, Anthony, and to Lucerne Partners.
All the best. Thank you, everybody, for attending today. Thank you.
Thank you.